Hi there, and welcome to another in our series of short videos looking at aspects of financial economics. In this session, we're going to take a look at the concept of moral hazard and link it to financial instability. So moral hazard is a concept you may have come across before when you focused on market failure. When someone pays for your accidents or problems, then you might be inclined actually to take less effort to avoid those accidents and problems, and that's essentially the concept of moral hazard. Now, applying it to financial markets, moral hazard happens when an agent, in for example a market, is given an implicit guarantee of support if they make a loss. For example, an insurance payout or the prospect, if you're a bank, of a state bailout. So if we take the commercial banking sector, particularly in the run-up to the financial crisis of 2007 through to 2010, there was a belief that the government would absorb any losses that bank creditors would otherwise bear. And that can lead to moral hazard because if the commercial bank knows that, for example, huge losses might lead to nationalisation, a commercial or an investment bank might take on more risk than is optimal. In other words, they might lend out more than they should really do for safety's sake. Why do they do this? Because they believe that they're going to receive any private benefits from the risk taking, they're going to make a higher return or a higher profit. But ultimately, if the commercial bank runs into huge losses, the government might bear the cost of a failure through a bailout or through nationalisation of some kind. And that, of course, is funded eventually by the taxpayer. Indeed, a phrase that became common during the financial crisis was that some institutions, particularly some banks, might be deemed too big to fail, leading to diseconomies of scale and also increasing the risk of systemic financial collapse. I think we certainly saw an example of that in the financial crisis. The domino effect of one financial institution running into difficulty, causing problems throughout the system. There's also an aspect of moral hazard in terms of the savings side of the banking system. If you guarantee the deposits of savers through saver deposit protection schemes, for example, then that could mean that commercial banks, for example, they don't have to offer particularly high rates of interest. They can attract deposits by offering perhaps a lower rate of interest to savers. This chart, I think, gives a scale of the consequences of moral hazard and bailouts. These are the costs of loans, bailout loans from the United States Federal Reserve during the financial crisis. And you can see that Morgan Stanley was in receipt of a bailout loan in excess of $107 billion, all the way down to Deutsche Bank got 66. And there was a huge financial cost to the US Federal Reserve initially in bailing out struggling banks. Now, some of that money will be recouped if the money is repaid, but there is definitely an issue to do with moral hazard in the banking system. Essentially, if commercial banks know that huge losses will be bailed out by the government, then that creates a problem of moral hazard. It causes them to behave in a more riskier fashion than perhaps they would otherwise do if those losses would normally lead to the failure of the bank itself.